Hello and welcome to the Credit Compass, your guide to navigating the complexities of European credit markets. Each week we step back from the noise to unpack the developments shaping credit, explore the macro forces behind them, and discuss what they mean for investors and issuers across Europe and the UK. Today we'll look at the other pillar of the AI revolution, power. The International Energy Agency has extended its timeline for peak oil consumption, but within its latest World Energy Outlook lies an equally important story: how we'll power the demands of the new economy. We'll also take a look at Howard Marks's latest memo and his reflections on risk discipline, and we'll wrap up with the UK's latest GDP figures, where Chancellor Rachel Reeves faces yet another negative number heading into the budget. Let's get going. Let's start with a topic that's rapidly gaining traction in the AI boom: energy. Last week, the International Energy Agency released its annual World Energy Outlook. Among its findings, AI-driven data center expansion will be a major driver of electricity demand in the years ahead. The energy intensity of AI workloads varies. Image generation and autonomous systems consume far more electricity than text-based models. Global investment in data centers now exceeds $580 billion, surpassing total global investment in oil supply. By 2030, electricity use by AI-optimized servers is expected to rise fivefold, contributing to a doubling of total data center energy consumption. In Europe, data centers alone could account for 6 to 10% of electricity demand growth through 2030. The US, China, and Europe together make up 82% of global capacity and are expected to host over 85% of new builds. On the flip side, AI is also becoming a key tool within the energy sector. The IEA estimates AI-driven efficiency gains of 3 to 10% across transport and industry by 2035, translating into meaningful global energy savings. But realizing those gains will depend on data quality, open data sharing, and regulatory alignment. By 2035, Europe's peak electricity demand is projected to rise sharply, driven by electrification from EVs to home heating. Battery storage and demand response systems are expected to meet roughly 20% of that peak. The key takeaway: Europe faces rising power bills and grid strain, but efficiency and cleaner technologies can offset part of the pressure. Now, imagine building a new wind farm, solar array, or battery storage project and being told the connection queue ahead of you equals 5 times the nation's current grid capacity. That's the situation in Italy, where first-come, first-served rules mean stalled projects can block shovel-ready ones from connecting. This grid bottleneck is fast becoming one of Europe's biggest transition challenges. Spain addressed it in 2023 by clearing out inactive projects. The UK is doing the same now. Italy, however, remains mired in delays. As AI, electrified transport, and digital infrastructure push power demand higher, slow grid expansion translates directly into higher costs for consumers and developers. Without grid reform, the energy transition will struggle to scale. For those of you that missed the KBRA Structured Finance Symposium last week, one of the panels focused on data centers. Here, it was outlined that the pipeline for financing projects in the works is growing, and this sector will become a sizable sector within credit markets. In fact, it is shaping up to develop into its own specialist sector, from corporate credit to project finance to structured finance, both public and private, as the world builds out computing capacity. All sectors of the credit market will be needed to be accessed to help fund the development of AI, and add to that the development and funding of power projects. That brings us to the ongoing cockroach discussion in credit markets. In his November memo, veteran investor Howard Marks from Oaktree Capital notes the rise in credit market warning signs, contract disputes, allegations of fraud, and stretched underwriting. He warns that credit issues are not systemic yet, but are systematic to leverage lending, and yield spreads are compensation for that risk. Credit defaults, as Marks notes, are more than roughly 2% of all bonds by value in a normal year in sub-investment grade. Marks argues that these recent signs of strain should reinvigorate discipline, stronger underwriting, deeper due diligence, and a renewed focus on prudent credit practices. In that sense, the cockroaches are constructive. They prompt the system to reset before excesses become dangerous. For long-term investors, that's a positive story. Now, last week, there were a lot of headlines for the UK economy as everyone sits in anticipation of the Chancellor Rachel Reeves's budget. However, she does not go into this with a great deal of strength. In the 3 months to September 2025, the UK economy registered growth of just 0.1%. Relative to the prior quarter, a clear deceleration from the 0.3% expansion that was seen from April to June. On a monthly basis, activity actually contracted by 0.1% in September after stagnation in August. The slowdown reflects a confluence of factors. In the production sector, output fell by around 0.5% for the quarter, partly attributable to a sharp drop in motor vehicle manufacturing following a high-profile cyber attack on Jaguar Land Rover, shutting down production for a period of time. In services, growth decelerated to approximately 0.2% as professional, scientific, and technical activities weakened. In construction, the new work subcomponent actually declined, which signals stress in domestic investment. The backdrop of fiscal uncertainty ahead of the upcoming budget, elevated household cost pressures, and tepid business investment have further sapped momentum. Looking ahead into the final quarter of the year, all eyes will be on whether government fiscal policy announcements, interest rate expectations from the Bank of England, and global trade developments can generate a turnaround. With such weak underlying momentum, risk tilts towards further softness unless meaningful boost to business or consumer confidence emerges. Let's hope the government, after all of the policy by press so far, lands on something constructive for the year ahead. So, where does that leave things this week? Well, as we head into year-end, markets appear to be catching their breath. Credit spreads have softened slightly as investors lock in gains. With Thanksgiving next week and the holiday season approaching, profit-taking is natural after a strong year. Marx's message resonates here. Periods of exuberance call for introspection, whether in private credit or AI. Faster the chase, the greater the chance for mistakes. So, take the moment, review your exposures, reflect on portfolio resilience, and get ready for what promises to be a fascinating 2026. That's it for this edition of the Credit Compass. If you found today's discussion useful, follow, rate, and share the show. It really helps others to discover it. And if there's a topic you'd like us to explore, please drop us a line. We're always open to listener ideas. For deeper insights and data-driven analysis on macro and credit trends, visit kbra.com/macrocredit, our dedicated hub for all things macro, markets, and credit dynamics. Until next time, stay curious, stay informed, stay resilient. Let the Credit Compass help guide your way.